Hello everyone. In today's video, I'm going to be revealing my entire stock portfolio. Now I'm going to give you a quick update. This is a bit of an update from my last video, which talked about the ups and downs and the percentage each of these stocks make up in my entire portfolio. I'm going to do something a little bit different today. I'm going to talk about what are my top holdings in the US market. I'm going to talk about my top holdings in the Canadian market and how have they both performed. I'm also going to talk about what stocks I'm looking to trim, and I'll tell you my reasons why. And most importantly, I also want to give you rules of thumb that you might want to use when building out your stock portfolio. I've had a few comments like some people are getting confused, like should you own this many stocks? It really comes down to your stock portfolio. So if you are looking to build more and more positions in your stock portfolio, or you're just getting confused how many stocks you should own, then you got to check out this video to the very end. So my first stock, and this is a new stock I've added to my portfolio, is ABBVIE. I don't know how to pronounce it. I think it's AbbVie, but it's a healthcare company, which is a big pharmaceutical company. And I bought the stock because of its dividend performance. And right now it's gone up 15.4%. I think I bought this like a month and a half ago. And this is one of the stocks I'm looking to seriously add more and more sizing to. I really like its dividend performance and the predictability about this US pharmaceutical company. The next stock I have, which is Algonquin Power, which I've covered in the past, or you've seen it in my stock portfolio, and this stock has gone up 14%. And this is a utility company in Canada and is a big dividend paying stock. My next stock, which is Alphabet. Now we all know Alphabet, which is a big, which is Google. And if you want to check out my last video, which I did about Google, check it up here. But all to say is that my Alphabet company stock has gone up 8.5%. Now my next stock, which is Amazon. Now I've bought Amazon, I think since 2016, and I pretty much didn't do much with it other than this year. I think I added more shares to it, which is why it's only gone up 41.4%. If you checked out my video on my last stock market portfolio update, you'll see that my Amazon actually did double. But because I've added more positions in it, this is why my total performance for that stock has only been 41.4% because I've been averaging up. Now my next stock, which is actually the longest stock I've held it for the longest time, I think since 2014 or 2015, which is Apple. Now, my total performance on that is only 181%, which is still pretty good. The only reason why my total performance is 181, even though I've been holding it on for this long, is because I've been averaging up. Like year over year, I've just been adding more and more Apple positions. I'm watching this stock like a hawk. This is like a super high conviction stock. Now, my next position is Aritzia, which is a big Canadian retail company, and it's expanding all across North America. And I still really, really love its brands. All my friends love buying it. In my last video, you'll see that Aritzia actually went down, but it's recovered and gone up even more. And it's because I've been buying it at the dip. Like it pretty much got slammed because of the exceptional circumstances that we're having. I picked it up when it was super, super cheap, and now it's gone up by 24.4%. And this position I think I've held for less than a year. Now, my next position is ARK ETF. And of course, this is like my favorite investor of all time, which is Cathie Wood, because I love her style investing. She loves investing in technology, innovation, disruptive technology, which is more or less like, I would say like I have no comparison to her, but her style investing is a little bit similar to what I love investing in. Now, of course, she invests in like really, really emerging trends, emerging markets, which is like way too early for me. And rather than understanding every company she invests in, I just buy her ETF. And this is my only ETF in my entire stock portfolio. And that's gone up 41.7%. And I bought that starting this year, a few months ago. Now, my next position is Bank of Nova Scotia, which is like a super boring, predictable bank. This one, I bought it because of its dividend performance. This stock was in a drip, meaning it was dividend reinvested. So I think it added more shares. But personally, I actually never added any more positions this year. It's only up by 0.7%, which is better than last time I did my stock portfolio, which showed like a big down. My next stock, which is Canadian Western Bank. This one is a smaller bank, really concentrated in the Western Canada. And this one is now down 4.8%. And I've been buying this because of its dividend performance. It still hasn't fully recovered, and it's just down by a little bit, by 4.8%. Now, my next stock, which is, you probably all know about it because I've been doing a couple videos on CloudMD, and this one has gone up 140%. Now, The reason why it went up 140% is because I bought it pretty much near initial public offering. It's gone up 140%. And actually, I did add more positions just I think a few weeks ago. So I've been averaging up. Now, my next position is Enbridge. And this one is like a big utility company. I mean, it's big gas and distribution company across North America. So I'm down 2.3% in my Enbridge stocks. Now, my next position is Facebook. And this one, I started buying it actually during the crazy bear market that happened in March. That was the first time I bought Facebook. And also because I bought Oculus Quest and I really like Oculus Quest. This one's up by 11.3%. Now, my next position is Fortis, and this one, I've been steadily buying this. I'm not expecting like huge returns from this company, but because I just kept averaging up, now my stocks are only up 0.3%. But when you buy these types of stocks, I don't really care so much about capital appreciation. I'm really caring about the predictability of this huge dividend player, which is growing its dividends year over year. Now, my next position is Granite Real Estate. This one is actually super surprising. I actually went up 21.9% and also love its dividends. That's really why I actually bought Granite Real Estate, was because I really like the distributions from this company and I think it has a lot more growth in terms of increasing their distributions. My next position is InterRent Real Estate. Now, this one is my recovery play. Now, I've been buying this because obviously this type of sector, like the real estate sector, the REITs have been slammed. I owned a very tiny position way back. I think it's like 1 year ago. And I've been buying actually more since the bear market crash happened in March. I'm still down about 14.8%. So this one's going to take some time before it recovers, but this is my recovery play because I think it has a lot going for it. And you can check out my video up here if you want to learn more about InterRent REIT. My next position is Manulife. This one I bought because it's a huge dividend player, and this one I am down by 7.9%. But this is a huge insurance company. Now my next stock is Microsoft. Now everyone knows about Microsoft. I mean, this one I don't even need to explain, but I'll just say that I'm up by 78.4%. And I've been actually averaging up in my Microsoft stock. I should definitely be up if I never positioned up. But because I have still quite a bit of conviction in its Microsoft company, in the growth, in their different revenue streams like gaming and Azure. This is why I've been averaging up into Microsoft. Now my next stock is RioCan Real Estate. Now this one again is a position I've been buying because I think it's a recovery play. When I talk about recovery, I'm talking about turnaround stocks because this sector has been slammed because of obviously our circumstance. This one's going to take probably about a year or two to really recover. When we get back to normal. So this one I'm only up by 5.8% despite me buying it pretty cheap, but I've been averaging up, over the past 6 months. And I actually owned a position before the whole, crazy circumstances happened. So averaging in between, I'm only up by 5.8%. Now, my next position is Smart Centers. And again, this is another stock that I bought because it's a recovery stock for me. Now, it does pay a really healthy, awesome distribution, but that's really not what I was focusing on. I'm really focusing on it's a bit of a capital appreciation with Smart Centers. So we'll see how that happens because it's down by 4.3%. Now, my next position is Square, which is a high growth company, which is trying to disrupt the whole finance sector. Basically trying to get you not to use brick and mortar banks and changing the way people pay online and pay at the restaurants. So I built I would say a small position in Square. I bought it I think 4 or 5 months ago. I can't remember, maybe 6 months ago, and now it's up by 44.9%. Now my next position is TELUS. This one is a boring telecommunications company. And why did I buy this Canadian telecommunications company over any other communications company in Canada? Well, that's because first, I really like its dividends. I like its dividend performance. And I also think that it is a bit more innovative than any other telecommunications company in Canada because it has TELUS Healthcare. It's been spending a lot more money in trying to get people to do virtual medical care. Now, I haven't been jumping onto its virtual medical care platform, but I know from a few of my doctor friends, they use TELUS Healthcare. So this is why I've actually built a position in TELUS. So I like its dividends and I like its catalyst, its innovation in the medical healthcare system. Okay, my next stock, which is probably my newest and latest position. This one's not that old. I bought Tesla, I think in early August, and it's up by 78.8%. This is wow, this highest growth stock I've ever owned. And probably you're going to say, yes, I'm super late in the game. I didn't buy Tesla, like back 10 years ago, although I've been watching Tesla for 10 years. I didn't buy it because it's always a risky stock. It almost went bankrupt 3 times. It took me, a little bit of convincing to buy Tesla, and only bought it after 4 profitable quarters or 5 profitable quarters. So basically it needed to prove itself to me. And now it is the biggest position in my stock portfolio. Now my next position is Toronto Dominion. Okay, so this one, I've been actually sizing up into this bank stock because it got slammed during this year. So I've been just concentrating buying more of TD Bank than any other bank stock. In fact, I forgot about Bank of Nova Scotia. I just concentrated all my money into this one bank stock for a dividend stock. So if I had to choose any bank in my entire portfolio in terms of putting my money in, it is TD Bank. So this is why this stock, because I bought it super cheap, and although I've been averaging up because I bought this stock 2 years ago, it's only up by 13.7%, which is still pretty decent because TD's, bank stocks don't really change much. They're super predictable, super boring. And when you buy these types of stocks, you're really just going for the predictable income stream, which is dividends and the fact that they keep growing their dividend. Next stock is Very Good Food. Now I bought this stock because my kids love Beyond Meat and I want to support a Canadian company and I see a ton of growth in Very Good Foods. So I've jumped onto the plant-based food trend and I made a small position, Very Good Food. And this stock has gone up 537%. And I haven't bought any more positions since the first time I bought it because although I could, and I could definitely own way more shares. I think I only own 1,100 shares. I can't even remember. I need it to prove itself. Even though I have so little money in this, I'm not a gambler, okay? So for me, in order for me to put more money into it, I need the company to prove itself. It's scaling, it's growing, it's distributing its product. For me, I'm okay with buying it when it's more expensive because then it's more predictable. So I'm more for predictable revenue and predictable growth. So I'm holding on to Very Good Food. I'm holding for the long term and I'll buy more when they can prove themselves. Okay, my next stock is Well Health. Okay, this one is the reason why I bought them is because healthcare and the virtual medical care clinic area is just disrupting. I mean, we're changing. You can see it. It's so obvious. That's a huge trend and it's here to stay. So I decided to buy the 2 Canadian companies in Canada that do this. Well, actually 3. It's TELUS, Well Health, and CloudMD. Now, these are all still in their early stages. I don't know which one's going to win. Each of them have their pluses and minuses. Anyways, I started with a small position, Well Health. And I think I just actually bought this 3 weeks ago. So now it's only up, it's actually down by 0.8%, but I'm holding it for the long term and I'll see how it does. So that took a lot of time because I have 25 holding right now. Now I'll tell you what are my biggest positions. My biggest positions are in the US market is Tesla, Apple, Amazon, Facebook, Microsoft, and Alphabet. Now Alphabet is tied with Microsoft. So out of all those positions, Tesla is 23% of my entire portfolio right now. And if you aggregated all those stocks, they make up 53% of my entire portfolio. So you can see that I'm heavily concentrated into tech, into innovation, because those are the companies I understand the most. So out of my Canadian stocks, you'll notice that all my Canadian stocks, my biggest positions are all dividend players. And the reason why is because I want predictable income from it. So my biggest holding is Fortis, which makes up 10% of my portfolio. My next biggest position is TD Bank, and that makes up 8% of my portfolio. And then it goes Algonquin, RioCan, and TELUS. Now TELUS is tied with RioCan, each making up 4% of my portfolio. So in terms of Canadian stocks, they only make up 35% of my entire portfolio. Which stocks am I trimming? So for me, I'm looking to trim Canadian Western Bank, Enbridge, and Manulife Financial. Only because, first of all, for reasons why I'm trimming Canadian Western Bank and Manulife Financial is because they aren't the leaders in their sectors, in the finance sector, and interest rates are going to be low for the foreseeable future. So if I'm going to make, an investment in that sector, I want to be buying high conviction stocks and high growing dividend stocks, which is why I've been concentrating more on TD Bank. So I'm going to be rotating those stocks, Manulife Financial and Canadian Western Bank, and pretty much taking all that money and buying more like TD Bank. The other stock I'm looking to trim, and I've been saying this in my past few videos, is Enbridge. I've been actually trimming it for the last 3 months now, and I haven't trimmed it recently because I don't know what to buy yet. Maybe actually I'm going to take that money and put that more into ABBVIE, which is a huge dividend US stock. And the reason why I'm not so happy with Enbridge, it's not because it hasn't been performing. I mean, it's a huge dividend growth stock. It's been around for like forever. Personally, I'm just not big in the oil sector. I'm not bullish on the oil sector. I just see it just becoming, it's just not the future. I mean, we got regulations coming in, for example, in Quebec, where ICE vehicles are banned by 2030. We've got China changing the game, that where, you know, they can't have ICE industrial combustion engine cars by 2035. I mean, it's eliminated by then. So I just see that there's the demand for oil is just going to slow down. So this is why I'm just looking to trim my position in Enbridge. You guys are really buying Enbridge because it's a huge dividend player, you love its predictable income, then that's the reason why you buy Enbridge. But for me, I'm not buying it purely for income. So this is my reason why for trimming. A very, very common question is, how many stocks should I own? So I'm going to talk about if you're starting out with a $5,000 portfolio, or you're starting out with a $20,000 portfolio, or you're starting out with a $100,000 portfolio, or a $200,000+ portfolio. Because in each size comes with a rule of thumb when it comes to owning stocks. But before I dive into the rules of thumb, I think the biggest question you should be asking yourself is, how much effort do you want to put in? Is the first question. And the second question is, what is your end objective with these stocks? Okay, so some of you are going to answer like, I just want to collect income. Or some of you are like, I want to beat the S&P 500. Or some of you are going to say, I just don't want to spend a lot of time like picking stocks. Well, those will give you insight on whether or not you should be picking stocks, spending time on building a stock portfolio versus buying an index fund. So before I talk about the rules of thumb, I just want to, fair warning, if you just want to like be a super passive investor, you don't really care to beat the S&P 500, then just go buy the S&P 500. Like just buy the index funds, because you know they still return very, very decently. I think like between 8 to 10 plus, I think actually 8 to 10% year over year for like a long, long, long time. And it doesn't take any work. It literally is like, I think some people call it like the couch potato method. You just keep saving money and re-injecting into these index funds, and then that's it. You don't really have to do anything. You don't have to research any of these companies. But if you want to start beating the S&P 500 and you also just really like understanding companies, then this is where you want to start picking stocks. So if you're starting with a $5,000 portfolio, I would recommend, as a rule of thumb, and this is general best practices, is just to own no more than 5 stocks in a $5,000 portfolio. And honestly, you might just want to be concentrated in 2 or 3 stocks that you have super, super high conviction. And at least if you're starting with something that small, even if you lose like, you know, $1,000 in that entire portfolio, it's really not going to set you back. I would just take it as just a quick way to fail and a quick way to learn what not to do. Well, to say, I'm not saying that you're going to lose $1,000. I'm just saying at least your position size isn't that big and it's not a big deal. So I would say no more than 5 stocks, because at least with each stock you can put in $1,000 towards that stock. Now, if you have a bigger portfolio, say you had $20,000, then you can own, say, up to 10 stocks, okay? 10 stocks. Please don't start buying like all like 20 or 25 stocks and just really spreading yourselves way too thin. Because it's just, for example, if you start buying, say, 25 stocks or 30 stocks in a $20,000 portfolio, you know, you're really spreading yourselves too thin. You can't keep on top of the stock, that type of stock portfolio. And you're probably just doing it as, you know, sometimes a fear of missing out, or you're doing it because someone had the stock tip. Really, the whole point of picking stocks is so that you can beat the S&P 500. I would place money that if you start buying 30 positions of 40 stocks in $20,000 portfolio, your returns are probably going to be at like the S&P 500 or underperforming. Okay, now when it comes to a $100,000 portfolio, that's when you can start adding more and more positions, because you just have more monies. I mean, you could buy 15 to 20 stocks. And then of course, if you have a $500,000 portfolio, like $500,000 plus portfolio, then you could be looking at 25 to 30 stocks. So I guess what I'm saying is that as you have more money, then you can add more positions. But usually when you have more money, you should also be spending a ton more time building up your investment knowledge before you start adding a position into your portfolio, because the whole point again is to beat the S&P 500. Otherwise, if you're not doing that, please buy the index fund. Now, if you are a person that likes to keep it safe, like meaning every position that you own, if it went down, it would not break your portfolio, then you want to have equal weighting to each of those stocks, or like equal weighting, actually probably better is equal weighting to each of those sectors. So if you have 3 stocks in the finance sector, then you want to make that like no more than like 10% of your position. So that's how, if that one sector fell, like the finance market just fell, then it would drag you down by 10%. It wouldn't really kill your portfolio. Well, for me, you can see that obviously I'm heavily in the tech space. And my portfolio, yes, can indeed drop like huge, like 25% swings. But keep in mind, I also have a real estate portfolio, which is the majority, well, not the majority, but getting a big proportion of my net worth. So even if my stock portfolio did drop 25%, then it really doesn't hurt my entire net worth. So you got to just really think of, again, what's your end goal? And if one thing or one sector did fall, would it really hurt your portfolio? Anyways, I hope you found a bit of those, a few of those questions super highly valuable. I don't think a lot of people are really ask themselves like what they really want to do with their portfolio, and if something went wrong, like how would they react? Because by asking those types of questions to yourself, it'll reveal a lot about your risk tolerance, your end objective, and position sizing. Anyways, if you found this video super helpful, give me a thumbs up, smash it, smash it. And of course, if you haven't subscribed, why not? I talk about stocks, real estate investing to ultimately build your income, grow your wealth, and, well, live your best life. Anyways, I'll see you in the next video.